You're watching us here on Midcap Radar. I'm Mangalam Malu. With me, Vivek. Here we have seen, the midcaps underperform this afternoon. Nearly 2,200 stocks declining for just about 400 stocks, which are advancing. Not particularly good for the midcaps, Vivek.
Good afternoon, Mangalam. The mid-cap and small-cap index under severe pressure. The small-cap index, in fact, down over 2%. But we have quite a lot lined up on the show. Let's start off with the top headlines. Markets off the day's low, but still trade weak. Mid-caps come under pressure again amid continued uncertainty over Trump's tariffs moves. Auto, PSU banks and consumer durables are the big drags.
IT sector relative outperformer today in an otherwise weak market. Mid-cap IT stocks like LTIMindtree, L&T Tech Services gain persistent system gains after JP Morgan issues an outperform call. Says the company is a credible growth compounder candidate.
ABB India beats estimates on all counts with revenues growing strongly across segments. However, the stock falls from the intraday high as management indicates moderation in order inflow and growth rates in their conference call.
MGL in focus after Mumbai Civic body BMC issues directions to all eateries, bakeries and hotels along with roadside vendors for switching to clean and eco-friendly fuel like CNG or PNG by July 8th.
Braid gain under pressure for the second straight trading session after weak commentary from the management. The company cuts revenue growth guidance to 12 to 13% from the earlier 15%.
Well, you're watching us here on Midcap Radar. While the midcaps are largely under pressure, a couple of them are surging as we speak. We have three of them that stand out. One is Godfrey Phillips. After a big gain yesterday, continues to gain today as well. And the other one we're looking at is Gillette. Gillette is up nearly 15%. There's no dinky toy stock. It is, extremely well bid in today's trading session. Stock had seen a correction of almost 30% from the highs, but now at lower levels, Street is buying into the improvement in urban discretionary. For them, the big trigger is increased revenue coming in from their female products as well. So that's a positive. Emami is another one which is actually doing well too. That's up around 3.5%. Swiggy, after having declined a fair bit, much below its issue price as well, has seen some bits. So that stock doing well too. But the stock under pressure is Borosil. So pull up the intraday chart of Borosil. You would see a decline of nearly 9%, opened with a cut of 15%. The company recently reported its third quarter numbers as well, where net profit and margins came under pressure due to increase in other expenses. So to discuss this and more on demand trends, we have Shrivar Kheruka, who's the MD and CEO of Borosil, joining in. Thanks a lot, Shrivar, for joining in. One of those rare days where, in the morning we got to speak to Mr. Pradeep Kheruka of Borosil Renewables, and that stock was higher. He foresees the future to be a lot stronger. And then in the afternoon, we get to speak to you as well. Both stocks in different directions today, but a rare occasion. So be that as it may, let's talk about your third quarter numbers itself. Two things disappointed the street. One was the lack of revenue growth revenue growth being at the lower end of what the street's expectations were. And secondly, your margins coming off as well. I was looking at your conference call details. You said that the lack of revenue growth was largely because of B2B going off because of the new, rule coming in with regards to sale or uniform code for pharmaceutical marketing practices. And the second part is to increase your e-commerce sales. You had to increase the cost of customer acquisition, and that impacted your margins as well. On both these fronts, if you could give us some clarity, how much do institutional sales account for in your overall mix? How much was, that impacted by? And secondly, what proportion of your sales come in from e-commerce? And what are the margin differentials between e-commerce and other sales?
Well, thanks for having me. Well, firstly, I'd say that we actually did not have a bad sales growth. It was, if you look at the first 9 months, we were somewhere in the 16 to 17% revenue growth area, which I believe is leading, amongst, say, our peer set. So in the last few years, of course, we've been growing more in the 20 to 25%. So from that perspective, yes, it's a bit lower, but we've always guided for a 15 to 20% CAGR, and we're currently somewhere in the middle of that. So that being said, yes, as far as margins are concerned, there were actually two separate impacts. One is what I would say above EBITDA, and one is below EBITDA. So, as far as below EBITDA is concerned, I think we've started a new plant last March for borosilicate pressware, which is the one of its kind in India. And, the depreciation has come into the balance sheet, or rather to the P&L statement from there, which has dented the PAT margins or the PBT margins. As far as above the EBITDA line, I would say yes, the 2 points you mentioned. Corporate gifting specifically from pharmaceutical companies has been much lower this year compared to the years past. I wouldn't like to exactly give you numbers because we don't share the uh, the channel wise sales breakup. But I would say it's taken at least 2, 3, 4% of our overall top line sales growth. So that has been a negative. As far as customer acquisition costs are concerned, we do see our basic strategy is we must reach the end customer. We love all our channels, but we love the customer more, and therefore the customer must be able to access us from wherever she or he desires. So at the moment, we have seen increasing revenue share in say e-commerce, and this is since the COVID phenomena, e-commerce as well as in quick commerce. And there you do need to spend more on advertising. So there has been a higher advertising cost as a result of that. But I would say in the long run, or let's say medium run, we have guided to an EBITDA improvement to between 20 and 22%, and that doesn't change because of one quarter. So that's likely to continue to be our goal in the medium term, and we are quite confident to achieve it. Also, one more thing that's changed, since the last quarter, of course, I think the budget was very positive from the middle class perspective, with more money in the hands of the middle class. And therefore, we do hope and we do expect that discretionary spending for household items will increase post the budget announcement. So in general, I would say we are going as per plan. One quarter down doesn't really do much. There's no longer term, negative story here.
What proportion of your sales currently comes from e-commerce versus what it was, say, pre-COVID? And how much are your ad spends as a percentage of sales? Where is that number likely to stabilize at?
Yeah, so as far as the ad spends are concerned, we are roughly around 8% of sales, which is much higher than the industry average. And in the past, it used to be 10, it's come down to 8. And I believe in the next, as we scale, operating leverage will allow us to get to about 6. So we should add another 2 percentage points in EBITDA from there. The other point is in terms of, like I told you before, we don't really share channel-wise sales mix for competitive reasons, but I would say e-commerce has multiplied manifold compared to before COVID, and we see that trend continue.
Not the exact number, but a broad range if you could give us, low teens, mid-teens, mid-single digits, high single digits.
It's definitely in double digits. It's definitely in double digits, but and it's rising rapidly.
Srivar, if you could, we are facing paucity of time, but if you could help us, number one, FY25, where will you end in terms of top line margins as well as PAT? FY26, what is the outlook like? If you can't quantify it, can you give qualitative outlook as to how exactly you see FY26 pan out?
Look, as far as the growth is concerned, if you look at the 9 months average, we've grown 16-17%. I don't see any reason why that should change in the last quarter. So you could just, multiply that. And I would hope that we could continue that same momentum in the next year. And as far as margins are concerned, I would say we're at about 17% operating EBITDA margins. And our goal is somewhere in the 21-22 range. And probably we should be able to add 1 or 2 percentage points to that 17% in the next year and hit that 21-22 probably somewhere in FY27.
Just a quick word before we let you go on your opalware business and your non-glassware business. Non-glassware has been a growth generator for you. Wondering whether you are looking at, manufacturing non-glassware products in-house versus completely outsourcing right now, because you're working on a few categories there as well. And in opalware, you are expecting some competition coming by. So will that impact your margins going forward?
Well, as far as non-glassware is concerned, we absolutely have grown that business a lot. We do expect, or rather the government has been encouraging companies to make in India, and we are fully cognizant of that, and therefore we do have plans to set up non-glassware manufacturing in the near future. Those plans haven't yet been fructified into a formal, say, approval from the board, which should happen shortly. Once I have that, I will definitely share that with you. But in principle, yes, we will be manufacturing some non-glassware in India in the short run. And as far as opal glass, yes, competition is coming, no doubt about it. There have been, there was a one-player industry, now it's a three-player industry. There may be a fourth player coming, no doubt. But these are all well-established and I would say mature players, and I don't think that margins should hurt because of that. I mean, it's only that the industry will take more share from competing, say, dinnerware, let's say, segments like maybe ceramics. So I don't believe the margins will be impacted from that.
Right, right. Thank you so much, River, for joining us, giving a sense of how Q3 panned out and how exactly you see the competitive landscape pan out. Well, we'll now shift into a short break, but here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back to Midcap Radar. Well, we have a very interesting discussion lined up. Sachin Mehta, Director of Investment Banking at Anand Rathi Advisors, joins us now. They've written a very interesting note as far as the global aviation as well as the aerospace market is concerned. Thank you so much for joining us. First off, Sachin, give us a sense of the opportunities that you're seeing in the global aviation market. How does India fit into the scheme of things?
Yeah, thanks. Good afternoon, Vivek. Thanks for having me here. Look, the global aerospace industry is worth more than $1 trillion. It's one of the largest industries out there, and one of the very few industries where you have a order pipeline which is available for the next 20 years. As you know, that there are more than 42,000 aircrafts which are currently on order, which will be delivered over the next 20 years. So this is a huge TAM to play for several Indian companies who are focused on precision engineering, very specifically within the aerospace and the defense segment. As we are seeing, a lot of Indian companies are rising up to the challenge with the support from the government as well. So I think it makes for a very exciting case for the aviation industry to grow within India as well.
Understood that. Sachin, the other thing which we want to look out is, what is the kind of opportunities, which are the Indian companies, both listed as well as unlisted, that stand to benefit from the increased spends that you're seeing as far as the entire segment is concerned?
Sure. So look, the aerospace industry, and when we specifically talk of the civil aircraft segment, you have various different segments within it. So you start with the aerostructure, which is roughly around 40% of the cost of the aircraft. Within that, you have different components, like you have fuselage, you have landing gear, you have several other things which make up the aircraft minus the engines. Now over there, as you can see, there are several Indian companies who are already making a mark. You have companies like Dynamatic Technologies, Data Patterns, Bemel, Sansera. These are companies on the listed side which have already tied up with some of the large global OEMs and have already become a key link in the global supply chain for them. On the unlisted side as well, there are many other companies like Many Precision, you have Aegis, you have Tata Aerospace, Godrej. These are some of the larger companies who are yet to go public. And, I expect a lot of them to start thinking of going public as well, because this is an industry where, as we see currently, there is tremendous amount of demand and growth is only restricted because of capacity.
Understood that, Sachin. Sachin, the next question is, how do you see the entire MRO market develop as far as India is concerned? Key players there, what kind of order books are they sitting on? What kind of order book growth can you expect them to see?
Yeah, very interesting point, Vivek. MRO market in India is very unique. As of now, 90% of the MRO services in India are outsourced to markets like UAE, Singapore, and even Sri Lanka, right? We have roughly around 713 to 760 commercial aircrafts which are operating in India, and there are around 1,200 more aircrafts which are on order. So 1,200 aircrafts means you have roughly around 2,500 engines which are also on order. typically you have a, A check, B check, C check, D check in the MRO, market. Now, for the more expensive, services like the C check and the D check, almost around 10,000 crore of spending is done by the airlines operating in India, outside India. So that is a huge opportunity. Plus, Indian airlines have, placed large orders for which now it makes a lot of commercial sense for a lot of these OEMs as well as third-party MRO operators to have their presence in India, because now there is a large fleet operating from India. And if you see, government has also, announced 100% FDI in the aircraft MRO sector. They have lowered GST as well. In fact, Safran has announced its largest MRO factory in Hyderabad. This is going to be their largest facility outside the United States. And of course, you have other JVs which have been announced. So ACUS is doing, has already announced setting up of MRO with Magellan Aircraft and so on and so forth. So this is a very large market, first to cater to the opportunity within India. And once you have a good base, you can also attract a lot of foreign airlines to come and do the MRO services in India. In fact, you also have Adani's, who have already announced takeover of Airworks. So you will see a lot of activity in the MRO space as well.
All right, take that point, Sachin. Thank you so much for taking the time out and explaining the sector macro to us. The next time we speak to you, we'll get a little micro and ask you for some of the best ways to play this in the listed space as well. Though, as you spoke, the picks were up for our viewers on the screen itself. Take a short break, come back, focus on the markets. A lot more stocks which are buzzing around, more on the downside than the up.
Good to see you. Have you been?
Very good. One of those massive roads today.
So much younger, much more. But 2025 is going to very one time.
Let's talk about Canva's startup story.
220 million people that use Canva as a product as well. They launched with 5 languages in 2016. They then ratcheted that up to 100 languages in 2017, including Hindi, Tamil. I think India could be huge, so it's our 4th biggest market at the moment. I think it could reach the #1 position, very soon. We've been able to move large parts of the company towards thinking in an AI-first manner.
Interesting.
24 million right now. So
Breaking news. The last few years have really been about the shiny objects, and 2025 is probably going to be much more about real use cases.
We've now matured our ML and our AI teams to adapt to this new technology, and we've pivoted every product team inside Canva now to think AI first.
Before we take your leave on Midcap Radar, just keep an eye out on the frontline indices. The Nifty, when we started the show, was lower by almost 70-80 points, but now has been a smidge of recovery, largely led by the IT pack. But no respite for the mid-cap end of things. The Nifty banked still down about 0.5%. All frontline indices, as you can see, in the red. We take a short break. On the other side, we have the Mutual Fund Corner when we return.